Happy Friday, folks. It's Shayan with Integrity Home Mortgage, back with your weekly rates rundown for June 26, 2026. So there was no commentary last week on account of the holiday, but let's make up for some lost time and have a quick review of the past 2 weeks today. Let's start with our benchmarks. 10-year Treasury yields are lower by 11 basis points from where they were 2 weeks ago, down to 4.37%. And the 30-year fixed mortgage rate is better by 13 basis points to just over 6.5%. Now, we're not going to do a full play by play over the last 14 days, but we are going to focus on the three pivotal events that have been most impactful to bond markets. And it's a mixed bag of events that had both positive and negative impacts. But the net of it all is that we're currently looking at the best mortgage rates we've seen in like 6 weeks. So, yay for us. Let's start with the first. Our first event was Kevin Warsh's inaugural meeting as Fed chair. As expected, the FOMC elected to hold rates steady once again, but the real news, as I indicated in my previous commentary, wasn't about the decisioning, but it was about the messaging. The written announcement was much shorter than we are used to, and Chair Warsh indicated that we should see this as indicative of their revamped communication strategy, which kind of boils down to less forward guidance, just the facts, and allow markets to interpret those facts as they will. We also got a fresh set of dot plots, which showed that the median expectation among FOMC members has shifted from a cutting bias to now at least one rate hike in 2026. He also reiterated that the Fed is still concerned with inflation and that 2% remains their target. That's important information. So, in all, the Fed meeting was seen as a hawkish pause, meaning they didn't change rates, but they're leaning more towards hiking rather than cutting, which sent rates higher last week. But actually, that only lasted a couple of days because that brings us to event number two, and that is the signing of the 60-day agreement between the U.S. and Iran, the 60-day peace agreement between the U.S. and Iran, and that was enough to make markets pretty much forget all about a hawkish Fed. Well, in fairness, not really forget, but maybe convince themselves that the Fed won't be hawkish for very long. The agreement, or memorandum of understanding as they call it, got off to a little bit of a rocky start, but it's held thus far. And with each passing day it holds, investors gain more and more confidence that a long-term deal will actually happen. So the MOU comes with it a reopening of the Strait of Hormuz and a lifting of sanctions on Iranian oil. That means once shipping normalizes, there will be more oil supply. So the logic kind of goes like this: more oil supply means lower oil prices. Lower prices means softer inflation, and softer inflation means less of a need for the Fed to raise rates. Oil prices are now down to right around $70, which is the lowest it's been since the beginning of the conflict. And we'll have to see in the coming months if the rest of that logic holds true because of event number three, which is inflation. Core PCE, which is the most impactful inflation measure when it comes to Fed policy making decisions, posted yet another month over month increase and has now hit its highest annualized level in about 2.5 years. So oil prices are lower, and we're seeing that at the pump, but it'll take a while for that to impact broader prices and to bring down inflation, which means even though gas prices might be beginning to approach pre-conflict levels, mortgage rates aren't and probably won't for several months at the very least. With the Iran war winding down, hopefully, mortgage markets will will get back to the business of focusing on data for the first time in like 4 months. And that means that we will have to see progress towards 2% inflation actually come through the numbers before we can hope to get mortgage rates back to sub 6% like they were in February. That's all I got for you this week, folks. Have a great weekend, and we'll see you next time.